Equity markets have been more choppy recently, and I think it's fair to say that more people now expect an equity market correction, if not a full-on market crash. So in this video, I'm going to look at 4 potential reasons why that might happen, and I've ordered them according to increasing probability. So now let's look at the potential triggers for an equity market crash in a bit more detail. The first trigger we'll consider is high inflation. Bank of America regularly surveys professional investors and asks them what they think the biggest tail risks are at the moment. And currently the biggest risk in fund managers' minds is inflation, although that has fallen slightly, with risk number 2 being a taper tantrum, number 3 being the Delta variant of COVID, and number 4 being asset bubbles. So certainly for professional investors, inflation is still a big worry. And if we look at the latest number for July for the United States, year-on-year inflation is 5.3%, which is the same as it was the previous month. But notice how it seems to have stopped rising, so it may be that it's actually topped out at 5.3%. But of course we'll have to wait for more data to see whether that's the case. In fact, to see inflation that high previously, we'd have to go all the way back to 2008 when it topped 5.5%. If we look at the components of inflation, there are 2 that dominate. One is gasoline, which is up 42% year on year, and the other component, which is up 42% year on year, is used cars and trucks. Now, if you've signed up for my free weekly market roundup, this won't be a surprise to you, and in that weekly email, I look at the most important macroeconomic news and how it'll affect markets. So if you want to sign up for that, just click on the link beside me or in the description below me. Notice the reasons behind that year-on-year rise are very different for cars and trucks and for gasoline. So cars and trucks are in red here, and you can see that they didn't dip in price during the pandemic. The shortage in supply of chips for new cars has driven up the prices of second-hand cars and trucks. But the thing to notice here is that this month that seems to have stabilized. So we may be seeing the peak in that used cars and trucks price increase. Gasoline, on the other hand, is very clearly a base effect because prices last year were much lower than they are now. And this dashed red line, which you can see, shows where the prices were last year for gasoline. So when we do the year-on-year comparison, we're dividing by a tiny number. But just as for used cars and trucks, notice how the price increase has started to slow down if we look at monthly data. So I think there are already signs in the data that this will be a transitory spike in inflation. And if that's the case, the Fed would be premature in raising interest rates because of this spike. If we look at other countries, such as the UK here, you can see inflation is much lower. So the most recent data for July shows a 2% increase in inflation, and that's if you don't include housing costs. If you do include housing costs, it's slightly higher at 2.1%. And in the Eurozone too, inflation's very muted at 2.2%. Although here too, if we look at the subcomponents, you can see that energy is up a lot. Not quite as much as in the US, but still up by 14.3%. So my opinion is that inflation will be transitory in the US, and elsewhere it's not particularly high. So I don't think this will be the trigger of a sell-off unless it fools central banks into hiking rates too early. So it may lead to a policy mistake which could trigger a sell-off, but I think that's quite unlikely. The next sell-off trigger that we'll consider is China. There was a nice article in The Economist recently talking about this new policy where they're clamping down on Chinese tech companies. And as you can see, the summary of the article is that it's likely to prove self-defeating. Now, many people are surprised that China would scupper the chances of its own tech unicorns. And The Economist's opinion is that this is the Chinese Communist Party simply trying to keep in power. So really, this is about Chinese leaders staying in control and maintaining political stability. But here you can see the cost of that decision if we compare China internet companies in red versus the broader Chinese equity market, which is in blue. Notice that the Chinese internet companies have been falling off a cliff recently, but looking at the blue line, you can see that hasn't spilled over too much into the broader Chinese equity market. So the China A-share equity market is definitely something you should keep an eye on, regardless of whether you allocate money to China or not, because this will almost certainly affect you. The third trigger we'll consider is a taper tantrum. What tapering means is that the Federal Reserve will slow down its purchase of assets, that's treasuries and mortgage-backed securities, where it's currently purchasing at a rate of $120 billion a month. Now, the criterion for slowing down those purchases is fairly low. All the Fed has to see is substantial further progress towards its dual mandate of full employment and stable prices. Now, what usually happens is once the Fed's finished tapering, it starts thinking about raising interest rates. Some people call that the Fed liftoff. And that's when the Federal Open Markets Committee decides to raise its policy rate, called the federal funds rate, which is currently between 0 and 0.25%, which is its zero lower bound. Now, the threshold to do that is higher than it is for the taper, because there the FOMC has to see signs of reaching full employment. And that's a much more stringent criterion than going for substantial further progress towards full employment. Now, both of these, the taper and the liftoff, sometimes trigger a market sell-off, but it does tend to be fairly short-lived. In fact, the FOMC just published notes from its previous meeting, and that triggered an equity market sell-off. Now, the Fed's being very careful not to repeat what happened in 2013, when there really was quite a big taper tantrum. And all Bernanke said at the time is that it would be appropriate to moderate the monthly pace of purchases later this year. It seems fairly innocuous, but even during the press conference, you can see that bond yields rose because bond prices were falling. And at the same time, the US dollar weakened versus many other developed market currencies. Now, in the upper panel of this graph, you can see the Fed's policy rate, which is the federal funds rate. And you can see this decade for which the interest rate was set at a zero lower bound. This lower panel shows you the size of the Fed's balance sheet, and that grew massively as a result of its asset purchases in the previous rounds of QE. But notice how the asset purchases stopped well before interest rates increased. And that's probably what we'll see this time. In fact, last time around, it took about 3 years between that taper tantrum and the time when rates actually started increasing significantly. So during this period between 2016 and 2019, you can see the policy rate increasing fairly steadily. But even as rates were increasing, notice how equity markets actually were fine. If we break it down by sector, there are only 2 sectors which fell, and that was consumer staples and energy. So I don't think either the taper or the liftoff of rates is going to be necessarily a huge problem for equity markets. There may be an initial shock, but I think that will be fairly short-lived if these precedents are anything to go by. Now, the comments in the Fed minutes this week, which spooked markets, was that some members of the FOMC thought it could be appropriate to start reducing the pace of asset purchases this year. Now, remember, for taper to happen, all that's required is substantial progress towards the Fed's goals. And in the case of inflation, the committee members consider their price stability goal to be satisfied. Where they don't see substantial further progress, at least not yet, is for employment, but it is close to being satisfied. So we could well see the taper happen sometime later this year. However, liftoff, when the Fed actually raises its policy rate, could be much further away. The unemployment rate in the US is shown here in blue, and the red line shows the CBO's estimate of full employment. Now, the most recent numbers you can see here shows that the unemployment rate is 5.4%, and full employment is well below that at 4.5%. So it may take quite a while to reach full employment and for the Fed to actually raise interest rates, but that could trigger some volatility when it does happen. The trigger that worries me most is weakening margins and earnings growth for US companies. You might be thinking, what's the problem? Margins are currently very strong, which is absolutely true. They're incredibly strong. So for the S&P beneath me, if we compare this year and last year, you can see margins are much higher than they were. In fact, that's true of every sector in the S&P 500. And this earnings season, we're on course for a 13% net profit margin. And that's the highest that FactSet's ever seen. But I guess my concern is what's going to happen next. We've already seen that the cost of living in the United States is increasing at a high rate of 5.3%. That's a blue line you can see above me here. But companies also feel inflation because they have to buy goods and services in order to produce goods and services. And if their input cost prices are rising, then that could reduce their margins. So if we look at the producer price inflation, which is the red line, you can see that that's been growing even more quickly than CPI. Now, at some point, something has to give. If companies are seeing more inflation than consumers, they have two choices. Either they can pass that on to consumers, or more likely, they're going to take a margin hit. So I think there could be pressure on margins ahead. And combined with the tax increases which President Biden's talked about, that could reduce US earnings growth considerably. If we look at the quarterly earnings growth, the bars in red here are the forecast earnings growth, and the bars in blue are historic earnings growth. There's a historic number here, which is 85% year-on-year earnings growth. You should really savor that for a moment, because this is not something you see many times in your lifetime. 85% year-on-year growth. But if we do see margins get eroded significantly, the question is, will that be sustainable? And I think the answer is clearly no. And if you cast your mind back to just before the pandemic, you can see that there were 4 quarters when earnings in the US didn't grow at all. It was completely flat. So this is my biggest worry for equity markets, which is that earnings simply won't justify such high prices, and eventually that always weighs on prices, and that ultimately could lead to a correction. So those are my 4 reasons why I think markets could sell off. I certainly don't think it's reason to panic, and for most people, remember it's best to just hold on to your equity and just buy more if it does fall. But if you do want to share your opinion about what the triggers will be, why not just stick it in the comments? I'd love to know what you think. And if you do want to help us, why not like this video or subscribe to our channel? That way you won't miss any further videos. And as always, thank you for listening.